welcome to Market Sense. I'm Catherine Murray, and I'm joined by my co-host, Andrew McCreath, and standing in for Randy Cass is Diana Avigdor. Well, let's take a look at some of the stories that are moving the markets today. U.S. Federal Reserve Chairman Ben Bernanke says the evidence is weak that monetary policy fueled the U.S. housing bubble. Speaking in New York, Bernanke added the first line of defense against any potential future bubbles is regulation. He also says the Fed is taking shadow banking issues very seriously. I think once again we hear very consistent messages from Bernanke. Andrew, what was your takeaway from today's speech?
I agree with you, Catherine, that he essentially said similar things to what Yellen and Dudley had said yesterday and the night before yesterday. He was a little less dovish than those two were, but he was certainly not a hawk. What surprised me of what he said was what he said about the Volcker rule. It struck me after reading his comments that he's not in favor of the Volcker rule. He said that there's not going to be a level playing field, U.S. institutions versus non-U.S. institutions. He said that we are definitely going to have to step in as the Fed to ensure the liquidity is there, given that the Volcker rule could potentially decrease liquidity in the marketplace. And he also said the Volcker rule raises a lot of complexities into the system. Into the financial system, which just continues to have very strong difficulties. I mean, what was your takeaway from this, Diana?
Bernanke, for the last few speeches, has been very, very careful to make sure that he's not throwing any curveball. He's being dovish at one time and other times not so much. In terms of the regulation, certainly does create a complexity of costs, and I think that he's recognized that. There are so many different rules and regulations in the Volcker rule. First, which ones are going to be taken up? So there is so much confusion. Certainly will put things in a little less competitive situation, at least initially.
And you know what, the level of complexity is to such a degree that we're actually hearing some people on the street say that it might be removed, you know, to quite a large degree because it is so complicated.
Well, there's certainly been a fair bit of chatter that they will hold back another year to smooth out some of the wrinkles in the policy. But no question, at least I should say from my perspective, there's no question that the change that ultimately was started by Clinton in the 90s that has facilitated the vertical integration of these investment dealers has been one of the catalysts for the problems that we ended up having in the latter part of the last decade.
All right, so bottom line as it relates to Bernanke, he really didn't move the markets too much, but China did. China's economy grew less than expected in the first quarter, accelerating at its slowest pace in nearly 3 years. The country's GDP rose 8.1%. That was slightly less than the economists were expecting at about 8.3%. Diana, what was your take on this? Were you surprised by the market reaction? Keep in mind, though, that China's markets actually closed in positive territory.
It's very true, and it closed in positive territory. Retail sales were good, industrial production was good, and 8.1% GDP growth is not so bad. But I think that some market participants, there was some chatter the day before that the GDP was going to come back at 9%. And when China announced their 7.5% announcement a couple of weeks ago, it was kind of fluffed off as it's not really going to come in that way, that it's just being managed. Expectations are being managed, right?
I like the components of the GDP number that China put up. I saw retail spending grow a little less than 15%, so the consumer is still very strong in China. And I think that's the key. You do want to see continued decreasing growth rates in some of the hotter sectors, i.e. construction. So I thought it was a good number.
And the day before we had the loan growth number, the loan numbers, which were amazing at over $1 trillion.
Very good numbers.
Now,
and
banks were up.
In addition, coming out of that first quarter, March was stronger than February and January. And I've seen a lot of commentary that has suggests that Q1 was going to be the bottom. And as a result, I think the market took the strong March relative to the weaker February and January as positive.
And isn't this a seasonally weak quarter for China, with them being closed for New Year? And this is a pretty good number.
Potentially the bottom, as many street analysts are saying. But do you think, Diana, like that the Canadian market tends to overreact on these China figures, and you should be buying on some of these opportunities?
You know, Canada is so exposed to commodities, and there's more than just China going on with commodities. Commodities, as a general investment thesis, has become a bucket of investment. It's not just supply and demand anymore from sovereign countries. You'll have some of that coming off as well.
And I just point out at the bottom of the hour here, we have Carl Weinberg of High Frequency Economics talking about China and its GDP outlook.
Okay, great point. Another item, though, that did move the markets was in the U.S. J.P. Morgan Chase beat the street in the first quarter as revenue rose 6%. And Wells Fargo also reported today the bank's first quarter profit rose 13%, coming in at 75 cents per share. Both of these banks beat. And at the same time, the financials were the biggest laggards in the U.S. markets. Dana, what's your take on this? Was it sell on the news?
Yeah, some of it for sure it was. The banks have been very well performing this first quarter, but some of it was also some performing loans were put on the non-performing side, and loan growth on the consumer side was not so good. I think Wells Fargo was actually down, commercial was up, which some people took it as okay, so the consumer's not doing that well. However, the expectations that were built in were very, very high, and in a day like this with risk off already from the whole week, I think it's a bit of profit taking as well.
Diana is referring to the quality of the earnings because the headline numbers were good, and so people say, why are the stocks down? But as Diana said, loan growth wasn't very good. The NIM margin was flat, and in addition to that, the big beat was on capital markets.
Which is, what valuation do you put on that?
Well,
I mean, they've been being so volatile
in the past.
In addition to your fair comment, it's also a transient business, and we know how the markets are right now.
That's right. The first quarter was very good, so of course they had great trading numbers.
So the key figure here then was the loan growth or the lack thereof, and people are reading into that as to how it might affect or impact some of the other banks, the regionals in particular, were down quite significantly today.
For sure.
And that in turn it relates to something we're going to talk about later called the monetary base, because the monetary base has been shrinking, and that is partially due to the fact that loan growth is not there.
Okay. Well, we'll talk about that in a little bit. You keep referring to the future. All right. If you have questions on the markets, you can email us at marketsense@bnn.ca, or you can tweet us at marketsensebnn. And when we return, has the decline in the oil and gas sector opened the door for investment opportunities? We're going to discuss that with our next guest right after the break.